Hello and welcome to CMS Forex Daily Video Recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, August 6, 2010. Let's start with today's big news, which was the non-farm payroll report out of the U.S., which showed that the U.S. economy shedded more jobs than expected in July. Non-farm payrolls fell by 131,000 as the growth in private sector employment, which rose by 71,000, was not enough to counter the sharp drop in government employment, both a 143,000 census workers that were let go, but also about a 50,000 drop in government workers from the state and local level. Forecasts had called for about a 65,000 drop in the overall payroll figure. June's data was revised lower as well, as payrolls fell by 221,000, more than the 125,000 drop previously reported. In that revision, we saw private sector jobs gaining only 31,000 in June compared to the originally reported 83,000. The jobless rate, which is calculated using a separate household survey, held steady at 9.5% in July. Economists had expected it to edge higher to 9.6%. The data adds another piece of evidence showing that the U.S. recovery is slowing and losing momentum. The fear is that with unemployment still so high and consumer prices dropping, that the U.S. economy could fall into a similar deflationary trap that had hit Japan during its lost decade. That decade in Japan was marked by slow growth and falling prices. The Fed meets next week, and we'll see if this data tips them into considering taking some kind of steps to support the economy, whether it's to use cash the Fed will receive when its mortgage bond holdings mature to buy new mortgage or treasury bonds, or some other type of quantitative easing. Let's take a look at the reaction in the currency markets following the non-farm payroll report. Here we're looking at the euro dollar, and we see that traders sold the dollar against the euro and yen, a theme we have seen recently as weak U.S. fundamentals means that the record low U.S. interest rates will be around for longer, or that the Fed may take efforts such as further quantitative easing, which amounts to even looser monetary policy and a weaker greenback. The euro broke out of its short-term two-period downward channel here, breaking out at the 132 level and then pushed above 132.50, which was our high for the week, until settling at 1.3333 as our high for the day. From there, we saw probably a bit of profit taking for people that had bought this pair until we tested our old high, which had been resistance, now as support. So we had entered this week following a break of the 130 level 2 weeks ago. So we entered around 1.3050, and we look set to close above the 132.50 level. So definitely a big gain in favor of the euro as traders continue to price in a weaker U.S. recovery. Now, we did have a weaker industrial production report come out of Germany, Europe's largest economy, where we saw production unexpectedly decline in June. 0.5% on the month, led by a drop in investment goods such as machinery and trucks. Economic growth may weaken in Europe as in the second half of the year as governments cut spending to trim their budget deficits, but with the euro still about 8% lower on the dollar this year, European exports are still cheaper, which should help production to post gains going forward. Therefore, it's definitely worth watching where industrial production goes next in Germany as it leads the rest of the eurozone. As we can see, in annual terms, production is up 10.9%, weaker than we had seen in May at 12.4%. Taking a look at UK manufacturing, we saw it increasing for a second straight month in June as manufacturing output climbed 0.3% compared to the previous month in June. Overall industrial production, however, unexpectedly fell by 0.5% when expectations had it rising slightly. Still, the manufacturing sector reading is a positive and shows continued growth in that sector in the UK, which is benefiting from the upswing in general global activity. Similar to the euro-dollar pair, we saw the pound-dollar rally in today's trading. First, it fell overnight following its industrial production data, but then in the New York session, we saw it climb above 1.59 and then break the high for this week at the 1.5960 level, a level that had acted as resistance both on Tuesday and Wednesday. Now, we didn't go too much higher than that level, so we'll see how this pair reacts once we come back from the weekend and after investors and traders had a bit more time to digest the implications of the U.S. jobs data. But with expectations of some announcement of further measures coming from the Fed, which will be meeting on Tuesday next week, we can most likely expect the greenback to continue to be pressured after we come back from the weekend. U.S. bond markets plunged down after the non-farm payroll news, and we saw 2-year notes yielding a record low of 0.505%, while 10-year notes were at 2.85%. These weaker yields hurt the U.S. dollar Japanese yen, or favored the yen pair, favored the yen in this pair, as the spreads between U.S. and Japanese government debt shrinks and Japanese investors become less willing to invest in U.S. treasuries, which weakens demand for the dollar in this pair. So in today's trading, we saw it plunge from its overnight high around 86.15 down to support at 85. U.S. stocks were also battered following the release, with the Dow Jones Index down triple digits and the three main U.S. indexes all down around 1.2%. For the week as a whole, we had started around this 86.40 level, which was an important support in mid-July, but then we broke below it early on in the week, retested that level as resistance, and we see continued yen strength to end the week. So while there are some concerns from different Japanese ministers that the high rate of the yen may hurt exports, there have been no news from the finance ministry in terms of intervening in the markets in order to weaken the Japanese yen. In other words, we should continue to see this USD JPY trend we've been seeing over the last month or so continue, with the yen continuing to gain on the greenback. Now, we mentioned the very weak U.S. equities following today's jobs data, and we also saw oil drop around 1.8%, which increased risk aversion in the U.S. dollar-Canadian dollar pair. And when there's higher risk aversion, we see the greenback gaining. So we saw the pair find support yesterday at just above the 1.01 level, and in today's session was the 1.0150, and we saw it climbing, rallying around 150 pips from high to low in today's session until we ran up against 1.0350, and that is where our rally stopped. Zooming this pair out to show the last 3 weeks of data, we see we've been in a bit of a downward sloping channel, and in today's session we broke above the resistance level of that channel, as well as the 200 period moving average in the 1 hour time frame. So this is a pretty strong signal that perhaps this pair may see further climbs in favor of the greenback. Now that will depend on whether risk aversion continues next week if we have weaker equities, as well as oil prices. Now, we did have the Canadian dollar weakening also as a result of its own weak job report, as Canada's unemployment rate edged up to 8% as the economy unexpectedly lost a total of 9.3 thousand jobs in July. Some 139,000 full-time jobs were shed by the economy, but that was partly offset by a gain of 129,700 part-time jobs. It's the first month that the Canadian economy is not creating jobs this year, a sign that economic growth is slowing in that country after surging since late 2009. As we can see from the chart to the right, the Canadian labor market has regained most of the jobs lost during the recession during late 2008 and early 2009, and it is, like I said, the first month that we've seen actually jobs lost during this year. So that does it for today's market highlights and fundamental news. Let's take a look at the key releases. First from the US for next week. On Tuesday, I had mentioned we are going to have the FOMC decide on interest rates and come out with their statement. Wednesday, we get US trade data. Thursday, jobless claims as well as import prices. And on Friday, we get the CPI, retail sales, as well as a preliminary reading of August UMich consumer sentiment. Around the world, Sunday, we start with Australian home loans data. Tuesday, we get Chinese data on trade balance and their consumer prices, as well as Canadian housing starts. Wednesday, we get employment data from the UK in the form of the claimant count, as well as the Bank of England inflation report. Then on Wednesday night, we get the Australian employment change. Thursday, New Zealand retail sales, and on Friday, we get preliminary readings of GDP from Germany as well as the Eurozone for the second quarter. And that will wrap up our coverage of the Forex markets for this week. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you a great weekend.